All right, what is up, my beautiful audience? We are currently on the 21st of January around 10 a.m. EST. And yeah, I've just been on a roll with YouTube content, and we're not really at the format that I want to be at for the academy, the boot camp that I'm going to be dropping really soon. But I still want to kind of test out and kind of, format content in different ways to kind of see like what's more reactive, what, gets more views, what you guys like. But in this video, we're going to be covering market structure in depth and how to you can utilize market structure in depth to its fullest in conjunction with the volume profile. So it's kind of going to be like market structure and order flow. I think it would be kind of like a cool little video to explain and kind of show you how to set up a bunch of stuff on TradingView because the volume profile it is okay on TradingView and you can definitely use it to your advantage. Okay. But yeah, so bro, I genuinely can't even fucking speak today. But the number one thing that I see that people just don't really understand and know how to use and incorporate is market structure. And I'm telling you guys, if you can understand market structure on its highest ability, understand how an uptrend works, a downtrend, swing high formation, swing low formation, impulsive legs, corrective legs, change of characters, breaks of structures, internal, external structure, then you can genuinely level up your trading. Okay. And you guys, and listen, you might already be kind of experienced, but I'm telling you guys, watch this video through to its full because it's not just market structure we're going to be covering. I'm going to be covering how you can actually figure out these impulsive legs, these corrective legs, where they're going to form based off our volume profile. Okay, so let's get started. Okay, so number one, when we're characterizing a market, okay, markets move in waves. Now this is the theory on it. This is how the theory on markets works. Okay, there are uptrends, downtrends, consolidations, but mainly this is called swing theory. Okay, and in swing theory, this states that an uptrending market, when a market wants to go higher, is going to do so in waves. Okay, in waves. So it's going to look something like this. Okay, guys? Now, in this case, right, this is going to be a normal uptrend. Okay? In a downtrend, it's going to be this, but actually, can we do this? Yeah, we can just flip it. Nice. In a downtrend, it's going to look like this. Okay, so in a downtrend, we're making lower lows and lower highs. In an uptrend, we're making higher highs and higher lows. Okay, great. Now, obviously, that was one example, but market structure and uptrends, downtrends, whatever, can look very different. Okay, it's not an end all be all. There's two types. There's theoretical market structure and actual / practical market structure. Okay, now let's say we have something like this now. All right, something like this. Notice, right, that we have two types of legs. And what are legs? Legs are going to be the movements in the direction of the swing that can be used to characterize either high volume, low volume. But in this case, it's going to be impulsiveness and correctiveness. But in this case, you can see right here, based off the distance of the leg and the nature of the leg, we have specific names for it, which is what I'm literally going to be talking about. The legs that are in the direction with what the original flow of the market is going to be called an impulsive leg. Okay, guys? So this leg right here is called an impulsive leg. Okay? Let's see if we can pull out the text tool right here. Impulsive. Okay? And actually, I'm not gonna do it like this. I'm gonna delete all of this and just put it right at the on the leg itself. All right, impulsive. Okay, the legs that end up retracing in opposition to the main flow, the main higher time frame order flow, right? The trend is going to be called a corrective leg. Why? Because the corrective legs are usually smaller than the impulsive legs. So that's why they're called corrective, because they're just correcting slightly. They're correcting slightly, okay? And yeah, we can make this a little bit smaller actually. Yeah, there we go. They're just correcting slightly, and then we're hoping to make another impulsive leg, okay? Which again happens here. So this is kind of the nature of the market. It moves like this. All right. Let me copy this one more time. Here we go. All right, great. Okay. Now, again, this what we're looking at is theoretical structure. In actuality, if I were to show you what an actual, market structure uptrend looks like, it's going to be kind of different. So let's actually show you guys right now, on the 15 and kind of what it's going to look like. If we were to generalize it, okay, and then this last one is going to be up here. Okay, so we're on the 15-minute, but you can see this is kind of different, but overall it is about the same. Okay, it's just the principles are still going to be the same, but just you can have different microstructure and different just medium time frame structural changes. As you can see, like for example, we have all of this consolidation here, but if we were just to aggregate this into its swing high, well, it would just be this swing high here, then this would be the low that it retraces to, then we go higher, right? So it would just be this. And well, you're kind of noticing what I'm actually about to get into in the next couple minutes here, but we'll save that as a secret in a couple minutes. Okay, so now if this is an uptrend, how do we also characterize other parts of what we're seeing right now, of this movement, of this swing theory, of this swing movement? Okay, there are a couple ways, three different things actually. These points that you're looking at, okay, right here, the highs and the lows that make the actual corrective or impulsive legs, okay, those are going to be called your pivot points, your swing pivot points, okay? Specifically, you can call them swing highs, obviously in this case if it makes a high with one leg, and then a swing low if it makes a low, but I like to in generally call them just swing points or just pivot points in general, because you're going to notice that this is dynamic, right? Once we switch trends, we do things of that nature, it's going to look a little bit different, okay? But these are called pivot points. All right, so I'm going to label this right here with my text tool. All right, pivots. Okay, and the reason these are so important, number one, is because these are showing you where there is real-time supply and demand coming into the market. Okay, there's a reason why if we end up reacting off this point here, let's say we end up reacting off this point here and then going higher. Okay, there is a supply and demand based reason of why the market wanted to react specifically off there. It's not a coincidence that the market is randomly reacting off this point right here, okay? It is reacting off this point because there is an imbalance of buyers and sellers, okay? In this case, if we are moving higher from this point right here, this is an area of where there's an imbalance of demand. Demand exceeds supply, so price moves up, okay? There are more buyers than sellers at this point down here, which is why price ends up making this point and then going higher. Okay, why is this so important? Okay, because as an analogous little side lesson here, okay, these points, these swing highs and swing lows, if I were to mark them out now, these pivot points with our tool, all right, you can see this is what they kind of look like, all right, like this. But based off what I just said, okay? Based off what I just said, these areas are going to be the most important areas of our real supply and demand. Now, in this case, if we're looking at specifically just demand, we're going to, delete these for now. Our demand, these areas are going to be areas of where price could potentially retest to and then end up going higher or having some reaction like this, okay? It's pretty simple. Now, this theory can be applied on a lower time frame, on medium time frames, on any time frame. But I'm kind of giving you this perspective of the higher time frame in general. All right. But yeah. Okay. But specifically, yes, these areas will be areas of where price can retest and where because it's showing you where the real supply or demand is coming into the market. Okay, great. We understood this. All right. Now, how do we also characterize specifically, like how do we know when there's a confirmation that we're in an impulsive leg or a corrective leg? And this is the most important concept, guys. Like these two words I'm about to use, please write them down and like drill this into your brain, because if you can't get this, like genuinely you need to quit trading, because this is just too important. Okay, now you're gonna notice these pivot points, since we're characterizing, we're standardizing essentially a visual-based methodology of analyzing market structure, okay? Impulsive, corrective, pivot points, okay? when we close in an uptrend above certain pivot of our pivot points, okay, in an uptrend, if we close above our opposing, let's say a pivot point that made a high, okay, like this is going to be called a change of character. Now, actually, before we talk about that, we need to take it a step back real quick. Okay, when we're characterizing these swing movements, how do we characterize when, let's say, a swing movement is going from an uptrend to a downtrend? How are we able to standardize that and mechanize that and characterize that into a word? Okay, that is what a change of character is. A change of character, and I haven't marked it on the chart yet, is essentially when you are showing that the order flow, the swing structure order flow, is changing from one direction to the opposite direction. So if we were to mark out, let's say in this is just, obviously we're looking at one leg, right? I'm just to give you that example. I'm just trying to show you to give you that example. But if we were to show you the full picture, if I were to show you the full picture of this, okay? Actually, let's make this a little bit more balanced, kind of to do it like this, so it makes a little bit more sense. Okay, great, awesome. This right here would be our what? You would see this would be our impulsive leg, right? Our impulsive, our corrective, and then we have all our, all our pivot points, right? Like this. Oh, excuse me, like this. Boom, boom, right? Makes sense. Okay. When we're shifting, the first instance of when we are shifting from, let's say in this case, bullish to bearish order flow, that is called a change of character. Okay, change of character. Now, it's denoted by the letters in the acronym CHOCH, change, and well, it shouldn't be CHOCH, but COCH, change of character. Okay. I don't know why I guess my default just has it as a I made a typo in there, but COCH. Okay, let me actually see if I can just delete this here real quick and make it like this. Okay, COCH, change of, okay, I guess it's now it updated. Change of character. Okay, once this is established, okay, now the market can go higher. It can do a fake charge. Okay, that is a concept that we can talk about in a different video. But in regarding, ignoring the complex case scenarios, okay? If the market ends up starting to then go and trend in the new direction now, in this case, the bearish direction, if we make a swing leg, because if it, for example, if the market wants to go lower, right, it has to make an initial swing leg and then end up closing below that swing leg. But that's exactly where I'm going with this. We have to characterize that. That is called a break of structure, okay? A break of structure, and that's called a BOS. Now, if we keep trending lower and lower and lower, and we keep going in the same direction of our new order flow, this is going to be a continued break of structure, like this. Okay, break of structure. There we go. Until, and we're gonna keep doing this until, right, we end up closing above an opposing swing high now, which in this case we have happened right over here, and we start going in the new direction. This is going to be a new change of character. Okay, a new change of character. And when that happens, if we start trending in this direction now, our subsequent closures above our swing highs, our pivot points, are going to be called our break of structures. Okay, so it's a generalized methodology, a generalized terminology of being able to characterize how a market switches from an uptrend to a downtrend, as well as other complexities, right? Like showing our impulsive legs or corrective legs or pivot points. Okay, great. Now it gets way more complex than this. I'm just trying to show you like a rudimentary sense that is still in depth, but it gets way more complex than this. Okay, way more complex than this. I'm just trying to really break it down for you guys. Okay. And yeah, this is essentially what it looks like, right? If we have an uptrend, we're coming from here, this is going to be some change of character that happens here. We're breaking structure, breaking structure, breaking structure. Then we end up reversing. We have our change of character, which indicates, hey, we're potentially moving from bullish to bearish swing structure now. And then we end up confirming that change of character with our break of structure now because it's in the same direction of our original change of character, okay? The difference between The change of character and the break of structure is the change of character is the initial first instance of closure below an opposing swing high or swing low that indicates that the order flow has shifted, while the break of structure are the next subsequent closures in the same direction of the new change of character that was established. Okay, so I know that sounded like a mouthful, but too many people just get this confused. Okay, there is a difference between these two concepts. Now, when since a break of structure or a change of character is like a special case break of structure, but it happens first, you can just use break of structure like interchangeably, like when you're just talking, because well, that's like you're not, you know what I mean? You're generally talking like in your head. You can know it's a change of character, but then you might just say break of structure because people just like doing that, right? But yeah, I digress. Okay, now this is all great and all. Okay, but how do we take advantage of this as a day trader? Okay, as someone taking trades intraday, how do we take advantage of this? Now, the way we essentially do this is that in terms of probabilities, all right, what did I just tell you, 10 minutes ago? When you're looking at an uptrend, the best and highest probability moves that move in your direction or in a certain direction are going to be your impulsive legs like this. Okay? Your impulsive legs. Okay, guys? Like this. Okay, you can take trades in the corrective, in the opposite corrective, in the corrective legs, but those are less probabilistic. Okay, you want trades that are the highest probability, and this is what it means by technical order flow, technical swing theory. You want to get in trades that are the highest probability and have the highest probability of reacting and actually going up. Now, why does this occur? Okay, because what's going on is if we've established an uptrend, let's say in this case we've established an uptrend, okay? What this means is from a supply and demand perspective, there's an overall imbalance to the upside with overall buyers controlling the narrative. Okay, so buyers are controlling this market, and we want to get in with the buyers because, well, if it's like fighting a waterfall, fighting a wave coming against you. Do you want to ride the wave or do you want to fight the wave? Do you want to go flow with the river or do you want to flow up against the river? What's gonna be easier? Okay. Again, not to say you can't take trades opposing in that corrective leg. It's just a very, very hard to, and not hard to, but it's just, you need to have experience. And the reason is because people don't realize that trying to time and trying to catch these trades, trying to catch these reversal trades, you have to have a ton of experience because, well, you can have fake chachas, fake, and like I was saying over here, you can have fake moves because, like, say this happens, it has the chach, and then what's up happening? We end up just doing something like this, right? And we end up going higher because that's more complex structure, right? So that can absolutely happen. So you have to have a ton of experience to be able to do that, right? Anyways, now let's get into some sauce, the next part which I'm going to bring into here. So this concept is called fractalization, and this whole idea is that if we're looking at this, right? If we're looking at this whole picture, this whole swing leg. Now, this is happening, let's say, on a 4-hour time frame. These are 4-hour swing legs, okay? Now, what they're not showing you, and what's just fucking mind-blowing, is that when you're having these swing legs, the same thing is happening on a lower time frame, okay? On a lower time frame like this. All right, I'm going to mark this out. And it's fucking crazy, guys. It's crazy, but it's just how the market works, okay? And as you keep going lower and lower and lower, I fucked that leg up, but you guys get the idea. Yeah, I fucked that leg up. No, let's just do it like this. As you keep going lower and lower and lower, these legs now, like this, have their own, even those legs themselves have their own swing legs. Like if I were to copy this now, like this, right here, let's do it like this. They're going to have their own swing legs like this. And I know that, yeah, it's just a really bad representation, but you guys get my idea, okay? It's like you're having swing legs on swing legs on swing legs. But the beauty of this is we want to take trades on the lower time frame. So once we've established a higher time frame narrative, a higher time frame our higher time frame, swing structure, we can then apply this concept of fractalization and then end up getting in when there is a lower time frame change of character or break of structure, maybe based off what I taught you here, to then get in with the overall order flow and then essentially get these high probability trades that go in our direction like this. Okay, like let's say we know that we're gonna be in a corrective leg right here. We break above, we close, and on the lower time frame we find some level. We can get in like this, and we can just keep riding it, right? So then that's how you essentially get very, very high RR. Now on an intraday basis, you're not going to be able to hold for multiple days at a time, but it still applies, right? Once you get good at this, you can take, excuse me, you'll be able to identify high probability setups, and then to be able, excuse me, to take advantage of this phenomenon. Okay, and I'm really sorry if I'm stuttering and my words aren't cohesive as I like to usually have them. It's because it's not that I didn't wake up, but it's just like, I don't know, it's kind of hard, like trying to put a lot of quality and it kind of explain everything in my brain just articulately sometimes. I don't know. But yeah, so great. Now, this is where our volume profile comes in, okay? And this is the whole idea of auction market theory. Now, if you want to be able to access the volume profile on TradingView, okay, all you do is you come here, you press not here actually, you come to your projection tool right here, then you see volume base, and you can see your VWAP like I taught you before right there. And you can see your fixed range volume profile and then your anchored volume profile. And in this case, we want to use anchored. We just click anchored. And then in this case, if you want a weekly profile, I only use weekly profiles. We then anchor it at the start of the week. And then you can see all of the, the things that we want to see, our high volume nodes, our low volume nodes, our VAH or VAL, as well as our POC. Now, it's not going to look like mine. I have mine set up as to be similar to what I have on my order flow platform, which is NinjaTrader. But yeah, that it should be the same. Okay. Now, what did I tell you guys based off auction? Well, actually, you guys probably didn't watch the last video. Go and watch the last video. Go and like it. But why am I bringing this up? Why is the volume profile so important? Okay. Now, once we've understood this phenomenon of our change of characters, our breaks of structures, our impulsive legs, corrective legs, our fractalization. Okay. How do we know where these potential legs are going to form? And it's not what's the word I'm looking for? Not that difficult to understand where these potential legs are going to form. Okay, these legs, right? Like I said, from this example, okay, these legs are going to be able to be formed where there is a potential imbalance of buyers and sellers. Okay, that's where these legs are going to be formed. Okay. Because there's one methodology of being able to get in on the lower time frame after we've already made the leg, but then there's also another skill of trying to get in on the formation of the leg. So there's two different methodologies to do this at. Now, auction market theory essentially states that price will basically form areas of agreements, then form areas of imbalance. Form areas of imbalance. All right, find a new area of agreement, and then end up forming another imbalance and then forming another area of agreements. Okay? This is called auction market theory, that the market is always in a constant push and pull of supply and demand based on buyers and sellers. Okay? Now, this is where the volume profile comes in, because areas of agreement are going to have high volume. So if I were to take out the histogram here, or not a histogram, but my little handy dandy drawing tool, you're going to notice that if I were to draw out like a histogram of this, okay, it's going to look something like this, with the highest point of volume being here, which is our wait, that looks kind of like something, right? Like which is going to be our POC. Okay, so these areas where we form our agreement is called the POC, and the POC fundamentally is just an agreement of where the most interaction of buyers and sellers are, which means that this is the price that buyers and sellers have agreed upon. Okay, now the way a market moves just logically is that people want to, like, once you've agreed upon a price, okay, you're not gonna like the market is going to find new areas of balance that people want to agree price on. Okay, because there's no opportunity to arbitrage essentially. So that's why we have these areas of imbalance like this. Okay, that happen. All right. Now, when these areas happen, they're going to be low volume nodes. They're going to be areas where there's low volume. There's not going to be any activity on the profile. You're just going to see something like this, basically, right? You might have some, some activity here. You might have some activity here, but it's gonna, be essentially like a void, like no volume going on. And then these areas, these consolidation areas, are gonna be areas where, you have the highest volumetric activity, which is gonna be your high volume nodes, your POC. Okay. But the whole idea is that these areas of imbalance are where price will draw towards. So once we essentially have a low volume node and we've established a new area of agreement between buyers and sellers, we're either going to go, to either to the next area or to the in one direction, or obviously the opposite area to the other direction. But these are going to be points where we magnetize and draw towards. So in this case, obviously, we want to, we're going to, you can quote unquote inverse this area and then draw towards the low down here, right? In this case, okay. But it gets a little bit more complex, obviously, but yeah, that's just kind of the whole idea on auction market theory. And don't worry, guys, like this is just a rudimentary video that's still in depth. I'm gonna be making like a way more organized video on this, but I just want to get the point across to you guys and give you guys value. So let's look at this like in practice now, right? So we can see right here on this microstructure, right? If you were to overlay this microstructure, right, kind of like this right here, not microstructure, but this kind of like trend going on. Okay, great. So if I were to pull this all the way to the side now, like this, okay, well, this makes sense, right? What is this saying? It's saying that our highest areas of volume and activity are going to be here, right? Here, here, and here, okay, with almost no volume right here. So, which is, the low all the way over here. Okay, based on what I just taught you guys, okay, based on what I just taught you guys, we know that if these are areas of agreed upon supply and demand, all right, where buyers and sellers are agreeing upon a price, we're going to move to the next area of imbalance. So our next areas of where we're going to potentially go towards are going to be either here or here, right? And you can mark out these imbalances, these volume imbalances, or volume low volume nodes like this. And this goes a little bit lower, but like right down here. Okay, so I know for a very high probability, if we want to start dumping now, and there's an influx of sellers, buyers want to close their position, the sellers want to start coming in, right? We will, with very high confidence, end up going towards either here or here to find a new area of agreed upon buying and selling. And this specific area down here is where I want to see price go towards, because you can see we have a last week's high volume node right here. So that's going to be a POC, which is right around there. So that should be kind of the agreed upon price. So we're going to see something like this most likely. Okay. Now, obviously we're still in an uptrend, but this is what I want to see. Okay. And where I'm going with this is that when you've identified these legs, these corrective legs, okay, these next areas of where we're going to potentially either have an opposing change of character or opposing break of structure are going to happen at these areas of low volume. So if what I said ends up playing out, right? What I said ends up playing out of where we do something like this, let's say we end up then, coming down here, okay? And then we end up going lower because, well, we have this swing low here that was made like this. Okay. Well, what's going to happen now? Well, this looks kind of strangely familiar to what? This looks very strangely familiar to this right here, right? Over here. So this is going to be a change of character then. If we close below this level down here, that's going to be a change of character. And then once this happens, all we do is then what? We play a retrace to then go lower, which is then going to be our break of structure. And then we just keep playing this continuation, right? This continuation of retracing and then going down. And this makes a ton of sense. Why? Because we're already kind of at all-time highs very aggressively. We're coming into, we're still in Q1, but like kind of end of Q1, right? Into February, March. And then, with all this buying and stuff, we should maybe see some correction and then some equilibrium at maybe, some, low volume node maybe that formed relatively around here. I'd say 4,100 is a pretty good agreed upon price, but it's really that simple, guys. But we haven't seen that yet. Now, if you're too scared to take a trade off rip like this, well, it's very simple. Wait for maybe a secondary break of structure that happens below here, and then again, just play the retrace to somewhere around here based off another POC, another relative low volume node or whatever, and then you take it all the way down, right? So that's essentially how we want to play this. We always want to be looking at the higher time frame structure. So there's a reason I've been sitting out, guys, because there's no trades. Okay, this is so far, like I've said, the only way you're making money in gold right now is if you are swung into a position from essentially down here or like down here. Basically, remember, I was in this trade right here. Technically, if I kept holding it, which is kind of funny, I would be up like 50 RR on this trade. But I just find that kind of funny because I got in literally at the bottom of this move right there, which is kind of cracked. But yeah, so not every week, not every period, especially when you understand how the higher time frame works and how the lower time frame is just a methodology of execution to getting in and then focusing in on the higher time frame. You have to sit on your hands, right? But yeah, I hope that made a lot of sense to you guys. Now, I will say, if I were to kind of draw this out, let's see if I were to kind of can I draw this out or no? Uh, yeah, low key can draw this out, and then maybe we could flip it. Okay, well, yeah, maybe that's not the best drawing, but I kind of want to go a little bit more into the volume profile and kind of show you like what's a high volume node, low volume node, the POC, VA, HVAL. But I just think mainly I want to keep this for market structure purposes and kind of really hammering this point for you guys. But yeah, no, I hope this made sense. And I'm gonna quiz you guys to make sure I know you guys watched the video. Where will price, essentially TLDR, where will price draw towards? All right. I want you guys to answer that question. Comment it down below so I know you paid attention. But yeah, based off the volume profile, where will price go towards once it's established a POC and an agreement between buyers and sellers based off what I taught you in auction market theory? Comment down below. All right. But yeah, any other comments you guys have, video ideas, I'd love to see you guys comment that as well, and I will go ahead and make the video on that. And also, it looks like, oh shit, we have our we have a contract change in 8 days on gold actually, which is kind of crazy. So that's coming soon. But I love you guys. I hope this video made sense, and don't worry, I'm gonna make a lot more videos related to this and more in depth. But yeah, hope it made sense, guys. Enjoy your Wednesday, and let me know if you have any questions. All right, take care.